We just wrapped up going through SKHynix 2026 Q2 earnings call materials, and now we want to share what we took away with you. Look at this: revenue up 257% in a single year, operating profit up 557%, and operating margin of 76%, the company's own record high. A blow-on, right? And yet the stock fell 8.98% the same session. So here's the puzzle we're cracking today. When a company prints numbers this good and the market still sells it, what exactly is everyone afraid of? Grab a coffee. Let me walk you through it slowly. The company reported revenue of 79.3 trillion KRW, up to 57% in a single year, and operating profit of 60.5 trillion, up 557%. Operating margin came in at 76%, and the filing flags it as a record high 3/4 of every one of sales dropping straight to operating profit. Do the math yourself. That is not a normal manufacturing business. That is more like a toll booth on the AI build out. And here is the part that stings. On the day of these numbers, the stock fell 8.98% in regular trading, then bled another 2.05% after hours. The slide puts it bluntly. The market isn't doubting the performance. It's doubting the endurance. Our take is that gap between the results and the reaction is the whole story. So hold that thought. When the tape sells your best quarter ever, it's not arguing with today. It's placing a bet on tomorrow. The deck lays out where this company sits inside the AI machine, and it's worth slowing down on because the whole thesis rides on it. The brain is the compute, NVIDIA's GPUs, but the company's point is that a brain with no memory is useless. According to the slide, DRAM and HBM are the immediate workspace the AI chips actually think in, and HBM4 is what they call the current protagonist, scaling into mass production. Then NAND and enterprise SSD are described as the massive data vault for the AI inference era. Here's the thing. Think about your own computer. The fastest processor still crawls if it's starved for memory. So the company is positioning itself not as a commodity chip maker, but as the memory that every AI server simply has to have. Our read is that framing is the bull case in one picture, though a picture isn't a moat, and we'll test that later. The company breaks that 79.3 trillion in revenue into three drivers, and this is where you see the quality of it. On volume, the filing says DRAM bit shipments grew high single digits and NAND grew 14 to 16%, right in line with the guidance they had set. On price, this is the eye-opener. DRAM average selling price is up 30% in the quarter and NAND up 55%, which the company attributes to a severe supply squeeze. And on mix, enterprise SSD revenue doubled quarter on quarter, while SolidM's 30 terabyte plus drives jumped more than 300%. Pay attention to what that combination means. They sold a bit more at much higher prices and skewed toward the richest products all at once. To be fair, the bears would say prices up 55% is exactly what a cycle top looks like, and honestly that's a fair worry. But our take is when volume merely meets plan and price does the heavy lifting, the durability of that price is the only question that really matters. Now here's where you have to be honest with yourself, and to the company's credit, this slide is honest too. The filing shows operating margin at 76%, up 500 basis points, and EBITDA margin at 81%, both driven, it says, by structural price and mix gains. But then it prints a net margin of 118%, and stop right there. No real business earns more profit than it books in sales. The company explains it a 63.3 trillion KRW one-off gain from disposing of and revaluing investment assets, including Kioxia and ADR factors, and it tells you plainly to ignore that for the run rate. Strip it out and the engine that actually repeats is still that 76% operating margin. Underneath sits what they call a fortress balance sheet, 88 trillion in cash, up 33.6 trillion in the quarter, 69.4 trillion in net cash, and debt to equity of just 7%. Our take is the operations are pristine. Just don't let that 118% headline anchor you, because it isn't coming back. This slide is the company's own words in one column and the deck's decoding in the other, and it's the honest heart of the whole thing. Management says structural AI demand is shifting to inference and agentic AI will drive growth, and the decode calls that directionally true but unproven over a multi-year horizon. On supply, management says constraints will persist and capacity is locked in through long-term agreements, and here the decode actually agrees, calling it the strongest evidence of endurance. Our take is that's the one line on the page that turns a hopeful story into hard contractual obligation, and we'll come back to it. But then management claims unprecedented financial strength and promises to expand shareholder returns, and the decode is brutal, a blank check. No specific amounts, no concrete timelines. Think about it, 2 of the 3 promises are still just words, and the market, we suspect, priced exactly that skepticism. When a company this cash rich won't name a single number on returns, you're allowed to ask why not yet. If the last page was about promises, this one is the company answering with the timeline, and it's the part that genuinely impressed me. The filing lays out the roadmap. Right now in 2026 Q2, HBM4 is in mass production, not sitting on a slide, actually shipping. The second half of 2026 is the full ramp. 2027 brings HBM4E sampling and production, and further out sits HBM5 integration. Here's the line that matters. The company states HBM4 yields and quality are already nearing mature HBM3 levels, meaning the most expensive, low yield phase is already passing. For anyone who's watched memory launches, that's the whole ball game, because early yield is exactly where the money bleeds out. On HBM5, they claim advanced IHBM packaging that cuts thermal resistance by more than 30%, though that one is still a future promise, not a shipped result. Our take, and I'm maybe 70% on this, is the execution here is genuinely ahead of the pack. The bull case doing real work, not just talk. This is the page I'd circle if you only remember one, because it's the company's answer to the oldest knock on memory. Memory has always been a brutal cycle, boom, bust, and that's why the market instinctively treats every peak as a trap. The company's claim is that long-term agreements act as a shield underneath that cycle, raising the floor so the next downturn doesn't cut as deep. The filing lists 3 anchors, roughly 10 key clients, including the hyperscalers, 5-year base terms with multi-mechanism pricing, and deposits, purchasing commitments actually secured by the customer's own capital. That last one matters because a promise to buy is cheap, but a deposit on the table is not. To be fair, the bears would push back that a contract is only as good as the counterparty when demand truly rolls over, and that's a real caveat. But our take is if these terms hold, this is the single most important structural change to the story, turning fickle demand into contractual obligation. Now the deck does something I respect. It argues against itself and lays the whole debate on a scale. On one pen it stacks the bull weights and a typical supply restraint where capex is tied strictly to confirmed demand, plus long lead times for complex AI server memory, and a structural demand shift with full-year market forecasts the company cites at DRAM up mid-20% and NAND up high teens. But on the other pan sits what they label the ghost of cycles past, the reminder that at every super cycle peak in memory history, the big players swore this time is different. And here's my confession, I've been burned believing exactly that line before, so I don't take it lightly. So which is it, the peak or a new baseline? Honestly, I can't fully call this one yet. The evidence genuinely leans both ways. Our take is the supply discipline is the real new variable, but discipline is a choice, and choices tend to break when the cycle gets scary. So the company has a lead, and the honest question is what kind of lead, and this slide answers it straight. The moat, it says, is built from 3 things: stable yields, consistent quality, and massive on-time delivery, and advantage compounded since the HBM2E generation. But then the deck names the moat's own nature. This is an execution moat, not an IP moat. Chew on that difference. An IP moat is a pattern nobody can cross. An execution moat is just being better at running the factory day after day. The slide's own warning is that the primary threat isn't a rival matching the specs. It's SKhynix's own margin for error, one bad yield cycle and the wall cracks. To be fair, they've compounded this edge for years, so the base case is they simply keep executing. But our take is you should hold this one with a little fear. A moat you dig every single morning is a moat you can also stop digging. I love this slide because you learn more from where management squirms than from the whole prepared script. The deck grades 3 Q&A topics by how confidently management answered, and it comes out a perfect green, yellow, red. On AI oversupply risk, pressed by JP Morgan, HANA, and CLSA, management was green, firmly rebutting the fear, saying hyperscaler moves drive utilization, not a pullback, with expansion tied strictly to confirmed demand. On 2027 pricing power from SK Securities and UBS, they went yellow, confident on volume but dodging specific 2027 price detail, hiding behind ongoing smooth negotiations without a single number. And on shareholder returns and LTA ratios, flat red, the company refused to give amounts, timelines, or formats, citing ADR regulations as the shield. Notice the pattern: rock solid on demand, guarded on price, evasive on returns. Our take is that red box is exactly what the stock sold on the market forgives a lot, but it hates a blank where a number should be. Alright, this is the bear case laid out in 4 boxes, and I'm not going to soften it because these are the real risks. First, the base trap. The deck argues 2027 growth deceleration is mathematically inevitable because you cannot lap plus 257% and plus 557% comps without the growth rate collapsing. Second, the one-off illusion. Strip out that 63.3 trillion gain and the L18% net margin is a one-time mirage, just like we flagged earlier. CapEx bloat. The company is targeting the upper 40 trillion KRW range for new fabs like MFX, Yongin Fakes, 1PNT7 and M17, and high fixed costs turn deadly the moment demand rolls over. Fourth, price reversals. ASP surged on strict supply, but the deck's own history warns that once supply loosens, prices fall far faster than they climbed. Think about it, these aren't wild fantasies, they're simply the arithmetic and the history of this industry. Our take is any one of these is survivable, but two of them hitting together in 2027 is the scenario that justifies the market's caution. Here's the whole video in one sentence, and the deck nails it. The market didn't kill the fundamentals, it killed the valuation. Sit with that. It dissolves the paradox from page 1. The business is fine, the price simply ran too far ahead. On one side, the deck stacks the established fundamentals, a record beat, the structural demand story, the LTA lock-ins, the supply squeeze, all still standing. On the other side is what actually moved the stock: profit, taking on peak news, capex anxiety, and those brutal high base comps. And then it hands you the three questions the whole thesis rests on. Can HBM4 yields stay stable through the second half ramp? Will the LTAs actually protect the downside? And when will the shareholder return checks clear? The deck's own verdict is blunt. Answer those three correctly and the structural story holds. Miss them and the market goes right back to pricing this as a typical cycle peak. Our take is those are exactly the right three questions, and notice, all three get answered in the future, not today. So how do we actually keep score from here? The company closes with 5 gauges to watch, and think of this as your homework, not theirs. 1. HBM4 yield execution. The goal is a seamless second half ramp that matches HBM3 stability. 2. Blended ASP trajectory. They're guiding for a rebound in the second half as delayed high-value shipments finally land. 3. Q3 volume delivery. The stated guidance is DRAM bits up 10% and NAND up low single digits. 4. Capex discipline. The goal in their own words is to hold the line near the 40 trillion KRW range without panic expanding. And 5. LTA and returns progress. Expand beyond the roughly 10 clients, reveal the LTA revenue share, and finally publish a concrete shareholder return timeline. The closing line ties the bow. The company has proven it can capture the AI boom. The next phase is proving it can sustain it. Our take is that 5th gauge, returns, is the one the market is really waiting on. Deliver a real number there, and that red box turns green fast. Alright, last thing, radar always leaves you a light. Weighing this whole deck, the record beat, the real HBM4 execution, and the LTA shield on one side against the one-off distortion, the capex risk, and that blank check on returns on the other, I'm calling this one yellow. The business is flat out impressive. I won't pretend otherwise. It's the price and the unanswered returns question that keep my hand off the buy button. Here's my caveat set up front. If HBM4 yields hold through the second half ramp and management finally puts a real number and date on shareholder returns, I flip this to green, and I'm telling you that now so you can hold me to it. But if instead the 2027 comps bite and prices reverse the way this industry always eventually does, then even yellow was generous. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.